Everybody, I'd love to introduce Emily Grubert from Notre Dame University, and she's an expert in technoeconomic and life cycle analysis, and she'll be giving us an overview of, well, how life cycle analysis is valuable and kind of where and when to apply it. Yeah, welcome, Emily. Thank you.
Thank you. Yeah, really glad to be here. And thanks everybody for joining today. So yeah, I'm going to talk a little bit about life cycle assessment in the context of decarbonization, but as a modeling tool, what I really want to talk about is what LCA is good at. As Greg mentioned, I'm at Notre Dame, so here in Northern Indiana, and spend a lot of time doing life cycle assessment work, largely related to what it means to evaluate some of the dynamics of forward-going energy decarbonization. And I think just as a kind of a headline there, one of the things that LCA is really good at is prospective analysis of a lot of different scenarios. And I'll give you some examples of that as we go through here. What I think also I want to kind of emphasize is that a lot of the way that people try to use LCA is something that it can do, but is not necessarily designed for. And so some of the critiques that you may see about LCA being, not super precise, these kinds of things, I think are kind of a end result of the kind of tool that it actually is. So I'll try to talk about that a little bit. I think Greg said he'd be watching questions for me, and so happy to answer this as we go as well. Cool. So I think the first thing, and I say this to my students all the time, and I think that it's actually kind of an important thing to just keep in mind as you think about life cycle assessment, is that life cycle assessment is not a calculator. A lot of the time, I think the way that it gets used, and particularly in policy contexts, is as something that can tell you what basically the carbon emissions of something are. This gets used a lot in the context of carbon accounting, largely because people have realized that the life cycle of something is kind of important for understanding what those total emissions look like. So in this context, life cycle basically means from the time of materials extraction all the way through end use and materials disposal. The idea is to capture emissions and other things along the chain that are associated with different stages of the existence of a product, process, system, service, or policy, basically. But in many cases now, because of that focus on life cycle that a lot of other methods don't have, people have tended to view life cycle assessment primarily as a carbon accounting tool. What I'm going to kind of show you is that's something that it can do. It's not really what it's designed to do. And some of the weaknesses that we see in those spaces are largely because of that design mismatch. So what is life cycle assessment if it's not a calculator? Basically, life cycle assessment is a formalized decision support framework governed by an international standards organization method and a number of other pretty significant professional societies that are associated with how you actually do this. I think what gets immediately kind of frustrating to a lot of my students in particular is just the point that this isn't something where you kind of have a bunch of equations and you plug them all in and then you get an answer out at the end. It really is a framework. And so when you look at like the ISO documents, a lot of the time what they focus on is how you make decisions, how you make design choices about what you're actually assessing, these kinds of things, rather than, if you have this kind of product, these are the equations and the steps that you need to follow. So it's much more around decision support than it is around retrospective calculation in particular. And I think that one of the really important emphases that comes out of that basically is that because it's a decision support framework, generally speaking, it's been designed to evaluate multiple potential options in the future and try to get a sense of what the prospective impacts of doing something are going to be. So rather than saying, what were the emissions associated with the power sector in the United States 3 years ago, what it tends to be designed for is if we instituted a process that is likely to make our power plants more efficient, what would the emissions be probably going forward, and how does that compare to an alternative scenario that maybe has some other assumptions associated with it? So I think one of the core questions when you're thinking about LCA as a modeling tool, it tends to have to be, what is the decision that you're trying to support? Because that's really going to dictate a lot of the decisions that you make about how to run your modeling. So like I said, life cycle assessment is a formal ISO governed thing. It's governed by the ISO 14040 series, so notably 14040 and 14044, and there are a couple of others that kind of get into specifics about how you handle particular kinds of impacts. But one of the other things that's maybe useful to say up front basically is that as a modeling tool, this is actually something that's distinct, and you'll see me using the capital letters versus the non-capital letters to kind of emphasize this. It's distinct from life cycle analysis or life cycle thinking, which basically account for the fact that you're taking account of the entire life cycle of a thing, but it's not the same thing as this formally governed life cycle assessment framework. And I'll explain a little bit more what that actually is. But I think that a lot of the time, because it's been sort of brought into into the carbon accounting world in particular so heavily, there's a sense that when people say that they do LCA, they're really doing like greenhouse gas accounting or something like that. Life cycle assessment itself, though, is a bit more formal of a method than people sometimes realize. One of the things that comes along with that is that there are specific steps, approaches, and methods that you need to use if you're going to do an ISO compliant study. So we tend to think about this as goal and scope, life cycle inventorying, life cycle impact assessment, and interpretation are the 4 major steps. And there are a bunch of things that go into that in terms of how you actually run a model. It's not that important at the moment, but I think the point here is that contrary to a lot of other quantitative modeling tools, because life cycle assessment is a quantitative modeling tool at the end of the day, but a lot of the power of life cycle assessment is really more around how you design the way that you're thinking about assessing a decision. It's more of a decision analysis tool, frankly, than it is a calculation tool or something that's really very focused on like a causal mechanisms and actually trying to derive outcomes that way. So LCA is quantitative. This is something that has actually hampered its use in a lot of social impact assessments, just because the way that LCA is typically designed, basically, this is not super important for our conversation today, but it's matrix math at the end of the day. You have a list of flows and then a list of impacts associated with that flow, just in terms of trying to equivalate them to something that you're actually going to feel on the other side. So basically, if you have a unit of CO2, you need some way to assess what the impact on climate change is going to be, for example. But basically, it's matrix math. And so if you have impacts that you're trying to evaluate where you don't have particular flows per unit that you're evaluating, it's actually really hard to adapt LCA to those cases. So the main issue a lot of the time with some of the social impacts and then some kinds of environmental impacts as well is that this matrix math and marginal characteristic of LCA means that if you have situations where you have like a big impact associated with just starting something, that's not necessarily a marginal impact that's coming as each unit gets rolled off the line or something along those lines, it's going to be really hard to evaluate that. So like in a social context, even if you do have really good quantitative metrics for an impact, if basically announcing a project is going to be the thing that causes the social impact, and you're not going to be able to say like, you know, there's X amount of social impact per bottle that I'm manufacturing or something along those lines, it's actually kind of hard to include those types of things. But generally, LCA is performed using software, largely because it is a bunch of matrix math that is kind of annoying to do by hand. A lot of the time, like I personally work in Excel a lot. This is basically an accounting tool. It happens to be accounting for things that are not money most of the time, but it's basically an accounting tool. And so spreadsheet kinds of frameworks work pretty well, but there are also specialized softwares that we use as well. Less formal life cycle analysis or life cycle thinking can actually be really valuable still. But I think one of the things that distinguishes that from the kind of ISO compliant life cycle assessment is that it doesn't necessarily look at each of these individual steps. It doesn't necessarily use the kinds of guidance about thinking about uncertainty and those types of things that we see under formalized steps. But then also, I think really, really specifically, and I'll show you this in a second, life cycle assessment actually is required to look at any kind of impact that might be relevant to the decision that you're making. Sometimes we fail at that, but aspirationally, it's supposed to be a complete inventory of impacts as well as a complete inventory of the life cycle. So something like carbon accounting or water footprinting or something along those lines that only looks at one kind of impact category is not formally life cycle assessment. Still valuable in a lot of cases, but I think that distinction is kind of relevant when you think about LCA practitioners in particular.
So question.
Yeah.
The way you're describing LCA sounds a lot like GAAP, like as an accounting framework, I guess, but applied to like more than money. Is that fair? And can you contrast those?
Yeah, definitely. I think the difference in some ways is that it's actually a lot harder to have generalized principles for the kinds of impacts that we're looking at. But in many cases, you do actually see some pretty significant community norms about how to evaluate things. So, you know, you need to be maybe a little bit more specific to whatever it is that you're evaluating, because we don't have really, really well-defined stages in just product manufacturing the way that we can typically rely on with accounting. But yes, it's essentially accounting.
Okay, thank you very much.
Yeah. So what LCA actually does when you think about it as just a decision support tool. And I think what makes it so powerful, but is a little bit distinct from a lot of the way that it gets used, is that it looks at the whole life cycle, which is the piece that people tend to think about because it's in the name, but it also looks across multiple types of impact categories. And that piece of it, this like multi-criteria, multi-stage element of it, is really what distinguishes it from most other modeling tools, especially in the decision support space. So when we talk about the entire life cycle, this is the piece that people tend to be a bit more familiar with. So basically, like I said before, material recovery through return to the environmental system is how we tend to think about this for environmental LCA at least. But things like production, processing, transportation, conversion, use, and disposal, and really trying to distinguish that you may have impacts that are happening in the production stage that are avoiding impacts in the use stage, or impacts in the use stage that are happening because you didn't invest in the production stage. It's a way to evaluate burden shifting in time. That is actually, I think, really what most people think about when they think about life cycle assessment. That's obviously something that has been included in a lot of other kinds of tools, but this is kind of where that comes from initially. The other piece of it that is much less well known, I think, though, is that it really seeks to aspirationally look at all the kinds of outcomes that, again, governed by the ISO standard, basically any outcome that could affect the decision that you're making at the end. We've gotten to the point where because this is matrix math and because we need to think pretty carefully about how you roll up different impacts in various kinds of categories, and there's a lot of normalization that goes into that, we've kind of settled on a typical set in many cases, but hypothetically, at least, it should be anything that really is affecting your potential decision. But these are basically expert defined impact categories. So it's not like, if you go and you're trying to do a project, you just ask people what they think matters. Generally speaking, we have a set of things that we kind of evaluate. What those tend to look like are things like climate, smog, water pollution, toxicity. LCA actually, before carbon accounting got big, used to be much more focused on health impacts, which is sort of interesting. But then also things like habitat loss, abiotic resource depletion, these kinds of things. So there tend to be, depending on which method you're using, there tend to be sort of 10 to 15 outcomes that we typically investigate. And so looking at all of those outcomes across all the different life cycle stages basically is what makes LCA both really powerful and really, really data intensive. But I think the way to think about this is what life cycle assessment is good at, especially in a prospective setting where you're thinking about what might happen if you make a particular decision relative to some other choice. You can detect burden shifting across life cycle stages. So by making a decision at the production stage, I've made the pollution impact probably much worse during the use phase or vice versa. But you can also detect burden shifting across different kinds of what we call environmental compartments. So by reducing my climate impact, I've increased my water pollution or something along those lines. And so what the tool is really designed to do is give you this hypothetically and aspirationally pretty comprehensive view of where impacts are coming from, and then give you a sense of where they're actually trading off for each other if you make different kinds of decisions, and really trying to give you a sense of where the big impacts are coming from. What makes this so powerful as a decision support tool is that if you do this before a project is actually built or fully designed, so doing this during the design phase and hypothetically pretty early on in the design phase, actually allows you to change things about the project that you're doing in order to reduce those impacts. So if you suddenly see that by making a particular choice in your design, you're causing this massive potential pollutant burden during the use phase, you could think about whether it actually makes sense to invest in a higher efficiency process or something like that, and whether that investment of additional resources at the processing stage or something might actually be worth it. So this notion that you're actually trying to deploy this as a tabletop tool that allows you to spot potential problems before they've happened is really what this was designed for and really what it's good at. So all of that to say, basically, the way that this tends to get used now is as a carbon accounting tool. And because of the way that that differs from the original way that LCA was designed, you end up using a tool that can serve as a carbon accounting tool and probably is even maybe arguably better than some of the other things that are out there because of this life cycle perspective. But you're not really taking advantage of all of the power of this tool. So essentially, when you use this for carbon accounting, and in that sense, what I'm trying to describe here is when basically you're trying to use LCA to tell you what the carbon intensity of something that you've already done is. essentially you're using a prospective design tool as a retrospective calculator. So trying to say what did happen in this very particular setting to a high precision and with really, really specific data. And then oftentimes trying to use that for compliance in the context of like a carbon intensity standard or a subsidy or something like this. So probably the currently most famous example, although the outcomes are a bit in doubt at this point, is that life cycle analysis was actually required to be used for hydrogen under the US federal hydrogen tax credit that was promulgated basically under the Inflation Reduction Act. But the idea that you're supposed to be using a life cycle perspective to claim that you have reached a particular level of carbon intensity in order to claim a very, very large tax credit is a lot of why this has been in the news more recently. So because this is effectively an accounting tool, it can be used as a carbon accounting framework and often is pretty effective. What becomes kind of difficult is that, as with most modeling, LCA is very much a garbage in, garbage out kind of a situation. And as you can kind of imagine from looking at this is an incredibly data intensive method. Like when you look at really well done life cycle assessments that, you know, somebody maybe brings in a specialist company to do and evaluate a product that they're thinking about designing or something along those lines. So what happens in professional contexts? These can take a year and cost $100,000 kind of a thing. It's very, very data intensive. It requires a huge amount of information about the actual system that you're using, those kinds of things, because you do need to know things like how far are the trucks moving? What kinds of trucks are you using? Are you going to be actually shifting it over to you know, like a train for a moment and then shifting it back to a truck? Like those kinds of questions, even just at something as small as shuttling a product from one manufacturing facility to an end user or something like that, kind of help, I think, illustrate why this does get so intensive. And then you need to know within that, how much CO2 are you emitting? How much methane are you emitting? How much NOx are you emitting? Like all of these different things where you can end up, and the reason that we use software for this basically is you can end up with thousands or tens of thousands of data entries that all need to be correct. If they're not correct, the answer that you're going to get out is also not going to be correct. But because this tends to be used as a tabletop prospective design tool, we also have really adapted the method to help us overcome some of the small uncertainties and get at kind of a ballpark place that helps us actually evaluate relative options when we're thinking about decision support. So in the context of where LCA is actually really, really powerful, you maybe don't care about the number being exactly right as long as that number is wrong in the same way for all of the different options that you're using. You want a relative outcome because you're trying to decide between A and B. But that, I think, kind of helps illustrate why when you're actually using this as a calculator for compliance, where you need very, very specific information and you need that information to be correct because there's a financial flow or something like that coming along with it in the form of a tax credit or just knowing whether you're allowed to continue with your project. That's a situation where you actually need really, really high quality data and you need that data to be exactly correct. That's not something that life cycle assessment is really designed to do. It's not a measurement tool. It depends on a lot of measurement tools. And like anything else where you're counting up stuff, like actually having the ability to measure those things is important. But you don't really need life cycle assessment as such to get you to the point of being able to do a lot of these accounting processes. It's really just the same as typical monetary accounting. If you don't have the values that underlie what you're doing, you're not going to be able to get very far. If you do, then you can get pretty far, but you're not really leveraging life cycle assessment for what it was designed for. But I think the point is, a lot of the time, when you look at the academic literature and also even the practitioner literature on life cycle assessment, the focus, again, being on sort of these relative outcomes for decision support and getting kind of good enough to tell you whether you are making a robust choice means that when people look at that and then bring it back to a carbon accounting setting, they're basically curious as to why we don't have super like legally robust answers that we're able to bring to a court and basically say we are 100% sure that this is what's going on. People tend to think about life cycle assessment as more around the data collection piece than around this decision support aspect. So yeah.
I mean, this is all, to my mind, ties back to accounting, because you can go to a court with an accountant and say this is financial fraud and so on. But my impression from what you're saying is this is accounting for things that do not have an obvious dollar value, which is why you have so many more entities that you're quantifying and analyzing. And that appears to be the key complication of LCA compared to accounting. Is that fair?
I'm not sure, because I don't think that accounting is necessarily better at this. It's just that we tend to track money more closely than we track environmental flows. So like, you know where the money is. You don't necessarily know how much water you use. Like an example that I use with people a lot is like, you probably, you know, if you have to do your taxes, like, you know how much money you made last year. There's a paper trail. Somebody else has actually kind of made it possible for you to follow that. Whereas if you think about like, how much water do you use in a day? Counting your house, your workplace, like a restaurant that you might go to or something like that, there's really not a great way to get that number. So it's not really the tool that's the issue here. It's that the kinds of things that we're trying to account for within LCA aren't that well measured. And so the gap tends to be when people expect life cycle assessment to be doing the measurement, when really it's the thing that you plug everything into. So it's the accounting framework, not the monetary tracking. Accounting frameworks rely on monetary tracking to be effective. LCA relies on everything else tracking to be effective, basically. So I think I would probably say it's the same robustness as accounting, but the underlying data frameworks are not quite as strong as we see with money.
Okay, so then maybe the right characterization perhaps is it's accounting for commons. Anything that's commons seems to be falling into this LCA framework, and because it's commons, it's usually poorly tracked, like water use or carbon dioxide or air quality. Commons are not.
It can be. It's not always commons though. Like, there's also just things like how much pollutant are you emitting, like, and also the other side of LCA that gets interesting is it's also all of the technosphere inputs. So like, if I'm making a building, I'm also tracking the amount of cement that I use. I'm tracking the amount of steel that I use, those kinds of things. So it's kind of a bill of materials plus external flows on the outside tracking framework. But yeah, it's basically the tool relies on databases that maybe we don't actually keep up in quite the same way as we keep with things that have financial value.
So interesting. You're now talking about project management, which is not normal accounting, but adjacent to project to normal accounting. And so you have like waste on site, which is hard to track. So perhaps physical world as opposed to virtual money world is that major challenge, right?
Yeah, exactly. And I think the project management piece is the data part. So the LCA is the accounting part. And then with accounting, I think just like the monetary tracking is basically the project management piece that we see within LCA, if that makes sense.
Yeah, it does. Thank you.
Yeah. All right, so what I want to maybe spend a little bit of time talking about too is just how you can actually see LCA doing really neat things within the carbon accounting space. So like I said, the challenge with carbon accounting tends to be more around data tracking than anything else. We traditionally have actually, let me go back to that for a second. We traditionally actually have seen pretty good success with carbon accounting, largely because we're mostly looking at CO2. The nice thing about CO2 is that most emissions of CO2 are stoichiometric. So basically, because we track the kinds of things that lead to CO2 emissions at a very, very fine level, usually because they do have financial value. So like, I know how much coal I purchased because I had to pay money for it. Or I know how much natural gas I purchased because I had to pay money for it. When I burn those, because I know the general characteristics of the fuel that I'm burning, I know exactly how much CO2 is coming out to a close enough approximation that you can actually use that pretty readily. It's chemistry. And so assuming that you're not missing something massive about like a broken component of your plant or something where you're getting incomplete combustion, you can pretty reliably say how much CO2 is going to result from these kinds of processes. Where it gets tricky is when you start bringing in things that aren't tracked that carefully. And so probably for those of you that look at greenhouse gas stuff ever, probably the most famous example of this is methane. So methane is another really significant greenhouse gas, second most impactful for climate change after CO2. But because most of the methane emissions that we experience from industrial systems is accidental, or at least not entirely on purpose. Like, it's not necessarily an emergency or an accident every time, but it's not something that we're doing as a matter of course with intentionality. This is things like leaking pipelines, or like if you need to clean out a valve or something like that, just releasing some of the gas that's in a system in order to access it, things like that. So we don't track those with meters, and it's not a stoichiometric process because it's just some amount of gas that's escaping to the atmosphere. The carbon accounting frameworks oftentimes kind of break down there because there aren't really good ways to track how much greenhouse gas is actually making it into the atmosphere when it's not something that's linked to a flow that we're very careful about tracking. So we can make estimates about, how much a typical pipeline might leak or things like that, but we don't have sort of the direct causal mechanism and the causal measurement that we do with something like CO2. So we've been able to kind of fudge this for a while because CO2 is such an easy case. Similarly, because the impacts of greenhouse gases are felt globally rather than super locally, it's pretty easy to convert a flow, like an amount of CO2, into a sort of understandable impact. We have this well-mixed gas globally, so it's not quite the same thing as we see presenting challenges with a lot of other LCA things where, for example, the amount of pollution that ends up in a waterway, the impact of that is going to depend a lot on who's using the water, how close it is to people, like those kinds of things. So greenhouse gases are sort of an easy case in a lot of ways, and this is part of why we've actually been able to get through with it. But so life cycle evaluations of greenhouse gases are super important, but it's not really leveraging the full power of LCA. So what I'm going to talk about in the next few minutes is just what could you do with LCA instead if you're really thinking about greenhouse gases as your target, and why does this show up as a really powerful method beyond just sort of counting things. So using LCA beyond just its function as a way to track measurements that you've taken. So the first example that I want to bring up is renewable natural gas. This is a resource that people often bring up as a drop-in fuel, is what we call it, for fossil natural gas. Basically, the idea is it's chemically the same as fossil gas, which is the natural gas that goes through pipelines and probably a lot of you use for heating and cooking and things like that. But it is derived from, generally speaking, biological sources. There are a couple of other exceptions, but we'll just talk about the biological ones here. The idea is basically that if you're using methane that's derived from a biological source, the carbon is recently in the atmosphere and taken out of the atmosphere, processed through a plant or something like that, and then put back in. And so the idea is it's climate neutral because you're not taking CO2 you're not taking carbon rather that's been sequestered underground for millions of years, the way that we are with fossil. So the claim, generally speaking, is that renewable natural gas provides you an opportunity to use methane in a way that is climate neutral without having to change all of your systems out, really, and then without having to worry about climate impact. If you just use LCA as a carbon accounting tool, a lot of the time, and you see this with industry quite frequently, you'll see people kind of claiming, well, RNG is this resource that has this neutral CO2. So by the time it's actually oxidized back to CO2, it's not doing anything to climate. Methane is a pretty powerful gas, and in a lot of cases, methane that's being generated from biological sources, from like a wastewater treatment plant or a landfill or something like that, is going into the atmosphere as methane. If I burn it, basically, I'm converting it from methane to this climate neutral CO2 and preventing this very powerful greenhouse gas from getting into the atmosphere. So I actually have negative carbon emissions now, is the argument, basically, because you've taken a powerful greenhouse gas and made it into a less powerful greenhouse gas. This has entered into a lot of policy frameworks, most notably because California kind of has adopted this method of thinking about tracking. And so the idea is basically, if you had methane, some of that would have escaped and made it to the atmosphere. Instead, we're preventing it from escaping, burning it, and then claiming negative carbon for this. The policy implication of this basically is that by saying that you can blend that renewable natural gas with fossil natural gas, there are ways that you can essentially claim that having a few % of renewable natural gas in a typical natural gas system will neutralize the whole system and allow you to keep using fossil gas as a greenhouse gas neutral process. So that's just the pure carbon accounting framework. This is a place where life cycle assessment actually can really shine when you start thinking about the scenario development aspects and around thinking about it as a decision support tool that forces you to think about what the various alternatives for those resources are and really going into the flows as opposed to just looking straight at the carbon. So generally speaking, people kind of think about RNG as having a few different sources. So you could have biogenic waste methane that comes from waste, basically a wastewater treatment plant or a landfill that is making methane unintentionally. Then there's the situation where you have biogenic, so biologically derived non-waste methane from waste. So basically you're making the methane on purpose. I might take compost or something like that and put it in an anaerobic setting to try to make more methane. So I'm making it on purpose. And then there's non-biogenic, non-waste methane that takes a couple of different forms. It could be something like synthetic gas or similar. And then people will often think about it as available for use in power generation, home applications, or industrial applications, basically everywhere we use natural gas. And what gets really important from an LCA perspective starts to become the counterfactual that we're evaluating. So in this scenario design and in this idea of decision support, you have to think about what would have happened otherwise. That's the piece that often kind of escapes the conversation when we're thinking about just carbon accounting. What life cycle assessment can do is really help you probe those counterfactuals and get very, very precise about which flows would have been going to what other fates, essentially. So with RNG, a lot of the time we think about counterfactuals as being maybe displacing other resources. So if I'm using RNG, maybe I'm not using fossil gas. Alternatively, I could flare it. So basically light it on fire and turn it from methane into CO2 without necessarily using it for anything, or I could vent it and just allowing it to go to the atmosphere. So what advocates generally talk about is this very, very negative emissions resource that can be used to offset other kinds of emissions. They're basically making the claim that all RNG is biogenic waste methane that comes from waste. So methane that I didn't really intend to exist, and it's coming from a waste product that I'm then using in any of these uses to displace greenhouse gas intensive resources like natural gas. And the claim generally is that if I did not do that, it would have otherwise been vented. So this methane would have made it to the atmosphere as methane and caused a big greenhouse gas problem. So this is sort of the pure, if you're not thinking about counterfactuals very carefully, it's easy to assume that this claim is true. What we really look at in a life cycle assessment framework is basically not only what is going on now, but also how the system would change if you actually implemented this new process. We call this consequential life cycle assessment, where we essentially recognize that the industrial system is reactive to things that we do. So if I create a large new incentive, for example, people are going to change their behavior. That's something that LCA is also quite powerful for. But essentially, what we see when you look at this very closely under a system that's encouraging us to use RNG to displace gas or something along those lines, is that you're going to tend to see biogenic waste methane from waste a little bit being used. But in general, once you create a financial incentive to use biogenic resources or other RNG sources, you're actually going to encourage people to make more RNG. So like I said before, it's actually pretty easy to coax your biogenic products to make methane, basically by putting them under anaerobic conditions. So at a wastewater treatment plant or a landfill, I can change my process to make more methane or less methane. What we basically see when we look at this from a full scenario perspective is that in response to a financial incentive of being able to sell RNG or claim credits or blend or something like that in a way that people are going to pay you for it, people are going to start running their plants in a way that makes more methane. What that means basically is that you are going to tend to see new methane that would not have otherwise existed entering into the system. With that methane, you can't assume that any leakage from that system would have otherwise happened. And so this leakage actually starts to become climate intensive. You're no longer in a situation where the methane would have just gone into the atmosphere anyway, and you are doing a great climate service by capturing it and burning it. You are making a new greenhouse gas so that you can catch part of it, but it's still going to be kind of leaky, and now all of a sudden you have greenhouse gas emissions. The other thing that we tend to see when you look closely is that generally speaking, having a bunch of methane going into the atmosphere is actually pretty dangerous because it spontaneously combusts at a certain level. And so in almost all of these situations where you actually see appreciable amounts of methane that's being generated, so again, mostly landfills and wastewater treatment plants, they're almost all required to flare that methane. So basically, instead of allowing the methane to just go into the atmosphere, you have to burn it, in which case it's being converted into CO2. And so at the end of the day, when you compare the life cycle of what you're using the RNG to do, maybe for power or for heating someone's house or something like that, to what would have happened otherwise, you're not actually comparing this waste product that you couldn't control that's going into the atmosphere kind of unmitigated. You're comparing taking methane from a setting where it would have been burned and now burning it in some other kind of context, which may or may not be less efficient. And so you end up in a situation basically where when you look at this closely, you actually see that renewable natural gas has positive greenhouse gas emissions in most practical settings. And so that difference between like just looking at this in an isolated carbon accounting way versus actually using life cycle assessment to develop scenarios that help you understand what your actual decision process is with specific physical flows, I think really shows why this can be powerful, but also why it's not exactly an accounting tool, if that makes sense.
So then question, so this is one example of avoidance credits, right? So, and the odd incentives that come up with you creating more need for avoidance and so on. So that, I guess, is LCA, or how is LCA relevant for doing the whole concept of avoidance and documenting when you're really avoiding or when you are creating the demand for avoidance?
Yeah, absolutely. It's a great question. I think generally speaking with carbon stuff, LCA does not really account for true avoidance. It will do net avoidance within two systems that are bounded with each other. But generally speaking, like we would not in an LCA framework come up with the idea this is a negative emission. A negative emission would really need to have taken something out of the atmosphere and stored it. Within LCA, because it's a relative framework, you can say that avoidance makes this system less greenhouse gas intensive than another one. And if you set your baseline boundary to 0, in kind of an unbounded baseline setting, so not relative to climate, but relative to whatever it is that you're evaluating, you can see some negative numbers, but generally speaking, we don't really think about avoidance as being a negative outcome. What's also sort of interesting about LCA is that the underlying assumption is that any activity is going to cause environmental harm. We don't actually account for environmental benefit, which is why you sometimes do get some sort of strange negative numbers in some places. But again, those negatives are relative to an alternative scenario. And if that alternative scenario isn't well defined, it's really, really easy to grab that and sort of assume that the avoidance number that is showing up in an LCA framework is actually something that is a negative emission in a climate context, when it's actually a negative emission relative to a scenario that you're maybe not talking about anymore. But yeah, there are a lot of rules about how you think about what belongs to what. With life cycle assessment, generally, if you're doing it correctly as well, really being very, very careful that the things that you're comparing are fully equivalent is really, really important. And so if you have a situation where one system is providing a service that the other system that you're comparing it to is not, you're actually supposed to do what we call system expansion and make sure that you are accounting for the potential emissions associated with sort of the additional process that you would need to provide the same service. Greg, I think you're muted. I see you talking though. Sorry.
I apologize. So some of what you were saying is about incentives. Government creates incentives for people to, avoid, and so they have additional incentives based on their own techno-economics. But it seems like LCA doesn't really cover that. It covers that. It allows you to document what everybody's cost structure might be and emission structure, but the incentive structure, that would be another kind of economic game theory kind of analysis on top of LCA.
Yeah, well, it goes into the scenario design process, really. And so within LCA, we would call that goal and scope, but essentially designing what it is that you're evaluating. Yeah, all that kind of stuff comes in at that phase. So before you even start counting up the emissions that are actually going into a system, like actually figuring out what is it you're evaluating, what are the external conditions, and then specifically, like, are you actually trying to do an attributional LCA where you assume that the industrial system is static, or are you trying to do a consequential LCA where you assume that there are some things that are actually likely to change the underlying structure of the economy? Like, those are decisions that you make at the very beginning. So yeah, very much leveraging a lot of things that come from economics and other spaces, but it shows up kind of at the design phase for an LCA.
Okay, and then one thing that keeps popping up, at least to me, is this is a deterministic process, like regular accounting. But it seems like there's a design component here, which is more of a sensitivity analysis, a stochastic thing where you want to scan the space of possible designs and see the set of possible outcomes.
Yeah.
Is that a reasonable use case?
Yeah, absolutely. And I think the more that we use this for evaluating policies rather than just products or something along those lines, the more people have gotten interested in some of those stochastic feedbacks as well.
Okay, thank you.
Yeah, absolutely. Let me give another couple of examples just of where LCA can kind of be useful for thinking about how to evaluate scenarios. So I'll talk a little bit about hydrogen and CCS really quickly, and then if people have questions, I'm really happy to take them. So I think a lot of the work that I've been doing over the last couple of years is basically trying to take advantage of the fact that some of the big federal climate policies have called for people to do life cycle carbon accounting for a couple of tax credits, and basically trying to expand beyond just using it as a calculation tool and really trying to think about how scenarios help us understand how we should really think about these emission structures, because it's actually not as easy as just measuring something at the source and saying this is how much greenhouse gas is being emitted. You actually really do need to think about counterfactuals here. So I'll talk a little bit about 45V, which is the tax credit for hydrogen that basically says we'll give you $3 per kilogram of hydrogen. And just like as an asterisk, the market rate for conventional hydrogen right now is about $1 a kilogram. So really, really high incentive if you can prove that your life cycle carbon emissions are below a certain level, and then we'll give you a little bit less if it's higher emissions than that. And then 45Q is around carbon sequestration, usually applied to carbon capture and storage kinds of situations, but let me talk about this really briefly. So the way that I think LCA has been really powerful in these two scenarios is being able to evaluate whether the policy design and the way that some of the definitions are written are actually likely to lead you to genuine emissions reductions. So relying on something that basically just says count the CO2 at various places can lead you to some fairly strange places if you're not really careful about your alternative scenarios. So we looked at 45V, the hydrogen tax credit, and basically suggest that hydrogen policy could end up costing about $1 trillion just in subsidy allocation, and generate about 3 gigatons of excess CO2 equivalent emissions relative to a stricter climate policy scenario because of the way that this tax credit was designed. Obviously, in both of these cases, the fate of both tax credits is somewhat in flux right now. Of the tax credits that were passed under the Biden administration, we think that these are among the more likely that the Trump administration will keep around because they are so embedded in the fossil fuel complex. But that aside, basically what we suggest is that because of the way that they're leveraging carbon accounting in the federal rule, you could end up with this very, very high cost that actually increases greenhouse gas emissions relative to what you were trying to do. So in this case, kind of coming back to the RNG, and I'll just go through this really, really quickly. They basically were considering, and the final rule actually disallowed this, maybe hopefully a little bit because we had been talking about this fairly loudly for a few months. But basically, under the initial rule, there was the potential that they were going to allow for this equivalence of very, very negative emissions from biogenic natural gas resources. So that RNG that we were just talking about, blended with fossil gas and then basically applied to hydrogen to make conventional hydrogen with a little bit of RNG and make a claim about how much the greenhouse gas footprint was based on that very, very negative emissions view. So this is essentially the same concept as the RNG stuff I was just talking about, but in this case, we're talking about blending that RNG with some fossil methane, turning it into hydrogen, and then being able to claim a tax credit associated with an overall carbon footprint that isn't actually borne out when you look at what that resource is. And so what we were essentially arguing was that by setting up the system to say, first of all, you're allowed to blend multiple types of feedstocks, but second of all, we're just going to declare the carbon intensity of these resources to be very negative without actually making you prove that that's the case. They're potentially lining themselves up to spend a huge amount of money for very, very little or actually negative climate benefit. So this is one of these places where, like, why does it matter to do these scenario types of analyses? Like, we think this was potentially a $1 trillion scale problem if it had gone through. So again, lots in doubt about what's actually going on now, but the amount of hydrogen that you may have been able to support with this blended RNG was pretty much the entire market and probably would have shut out electrolysis. So the other example, which is actually kind of similar, is that in looking at carbon capture and sequestration in fossil power retrofits, so coal and natural gas plants, basically, using a couple of different takes on kind of incentive structures and alternative fates for a life cycle evaluation of what the total emissions could have been under the tax credit versus not the tax credit, we basically estimate that you may have seen somewhere between 0.4 to $3.6 trillion in tax credits that could have reduced greenhouse gas emissions by as much as 24% versus business as usual, or could have increased them by as much as 80% in the actually high cost version of the world relative to business as usual. So why is this a life cycle assessment problem? Basically, where this is coming from is an evaluation that we did that essentially tried to look at what would have happened to those facilities otherwise. So LCA is really, really powerful because it looks forward and tries to project what would have happened in a bunch of different situations. We basically argue that without the tax credit, a lot of the plants that could install CCS probably would have retired because they're very old and are getting to their end of life. With the tax credit, because it provides this operational resourcing and because of some of the dynamics of how utilities invest money and make their profits, what we were suggesting was basically you would drive those plants to run longer. Basically, instead of retiring, they would probably extend their lives to take advantage of these tax credits, and then also probably run more because the way the tax credit was structured was essentially pay you more for more CO2 generation. So with a couple of different assumptions, we come to these conclusions and basically show that under a full LCA evaluation of what the emissions would otherwise have been, rather than just assuming like everything stays totally static, basically on a life cycle basis, because you're comparing to a situation where the plants would have otherwise closed and run less, you were going to end up increasing emissions, but paying a huge amount of money for that. So another just like quick example of a place where actually using life cycle assessment as a decision support tool that really, really relies on very careful scenario design and really careful evaluation of the different options that you're actually considering can lead you to some, I think, important policy conclusions that a lot of other tools are not very capable of necessarily. Like there are huge numbers of modeling tools out there, obviously. LCA is actually really good at this kind of stuff. It's maybe gotten a bit of a bad reputation because it's not actually structured to be the very, very high precision individual absolute statements of what emissions intensities might look like. That all relies on databases that if they were good, this tool is fine for, but it's not really what it's good at. What it's really, really good at is this scenario design thing and this comparative relative evaluation of different options for a decision that you're making. Yeah, maybe I'll stop there. If people have got questions, I'm super happy to answer them. But yeah, thanks for having me today.
Well, yeah, thank you very much. Yes, I think, well, I'll start with just some. All right, so a lot of what you're describing the LCA for emissions purposes, it seems like it's, it's accounting, but also baselining. If you can specify what the baseline is and combine it with game theory, then you can say that people act on these incentives like this, game theory, and in comparison to the baseline, which has the total incentives, here's the difference.
Yeah.
Right, and it seems like a very powerful tool. So maybe like I can ask about other scenarios for greenhouse gases. So removals. If you account, here's a few different policies you can have that you can have very different incentives. If you say every removal is the same, then somebody who does absolutely nothing and grows a forest and leaves it alone gets a removal credit. What are the incentives there?
Right. Yeah. Thank you. And I'll try to hold myself in a little bit. I work a lot on carbon removal, actually. And I think one of the things that shows up there really, really strongly is, again, this baselining issue. Like with forestry stuff in particular, I think not everyone agrees with me on this. As a life cycle person who also thinks about carbon removal, one of the things that I think is actually really important is that we establish a baseline for the land sink before we start declaring what a removal is. So if we take the kind of IPCC definition of a removal as an intentional human intervention in a system to take CO2 that was in the atmosphere out and store it out of the atmosphere indefinitely, that starts to get really complicated if you don't define what the land sink should have been, basically. And so if you say, relative to a pre-industrial land sink or relative to a 1950 land sink or something like that, that actually gives you a place to start counting about whether you're above or below the line. Without that, you end up with exactly the situation that you're describing, where people are just like, I planted a tree, give me a credit, basically. And so you end up with this incentive structure that allows you essentially to destroy the land sink and then start to partially restore it and claim a bunch of removal credits for having done so. So without establishing a baseline for where that land sink and frankly the ocean sink also are starting from, I think we're going to have a really hard time with high quality evaluation of terrestrial and biogenic carbon removal in particular.
So, but okay, so when let me ask you about the more controversial but maybe powerful variant is, I have a very cheap way of making carbon. In fact, removing carbon. In fact, it's profitable for me. I would do it anyhow, even if you don't pay me.
Yeah.
Pay me. Now, the nice, I mean, the example might be something like I operate forests, and I operate forests in a profitable way that also sequesters carbon. Everybody in the world should be doing this, but they're not. But I am, because it's profitable. Should I get the money?
Probably not, because it's not an intentional intervention for the purpose of removal.
Right, but then it's hard to tell. How would you ever tell whether I'm making the money? So that now, in terms of global incentives, it's like regular markets, and now maybe I'm really talking about the game theory aspects of it.
Yeah.
Regular markets, there's a price for a good, and then some people can produce it cheaply, some people can produce it expensively. So people who can produce it usually cheaply make incredible money for arguably nothing, right? They just happen to be in the right position, but it gets everybody else on board. So now you have to do kind of this global LCA to figure out how much capacities get created by overpaying for some people.
Right.
Even account something like this.
Yeah, no, it's a good question. I think it's like cards on the table. I actually am a pretty strong advocate for not allowing CDR to be a profit-centered industry, because I think some of the incentive structures that you end up creating point to the notion that they're not actually going to be doing anything from the climate perspective for exactly a lot of these baselining reasons. So one of the things, and this is some work that I did with Shuchitalati, one of the things that we kind of talk about a lot is that if you have a profit motive for CDR, you're going to end up in a situation where people that are able to pay for the CDR are the ones that are going to be taking that CDR on board. What ends up happening, because CDR actually has two different climatic functions, one being an offset and one being a drawdown. So you can either offset an ongoing emission, or you can just purely take CO2 out of the atmosphere with no exchange, at least in present temporalities, basically. If you're in a situation where CDR is profit driven, you're going to tend to have people that are able to pay, being the ones that are paying for CDR, that's going to tend to be in service of an offset. And because these are really resource intensive processes, our argument basically is that CDR is a fairly limited resource. And so you end up in a situation where having a profit motive means that you're going to be spending a lot more of your CDR capacity on offsetting rather than drawdown, and then not leave yourself very much capacity for drawdown and certain kinds of offsets that people are not willing to pay for. So if you're offsetting for like flights or something like that, and you take up 2 gigatons of CDR capabilities, and we only have 3 gigatons of CDR capabilities, now all of a sudden you only have 1 left to play with for things like offsetting ongoing emissions from like agriculture in very poor countries or some of the drawdown stuff. And so that kind of reaction to a lot of these incentives is going to tend to lead you to a place where overall emissions are higher, I think. But similarly there, like exactly as you're saying, trying to design those scenarios and figuring out how people are going to respond, and therefore how other kinds of emissions are going to move in response, I think is where a lot of the scenario design stuff gets really, really powerful.
So what you said is, I find it surprising, saying that we have a upper bound, like a certain amount of CDR capacity, because normally when you have industrial planning, you're thinking of if you pay for it, it'll come. I mean, if you're thinking of just force or just one technology, you have some constraints. But we have many ways of removing carbon, most of which are not being paid for. Like money is the bottleneck. So now the question becomes, if I can get more people to pay, suddenly my capacity goes up. Is my assumption.
Yeah. So there's 2 things there, I think. So your capacity does go up if people actually deploy more CDR, but your actual climate impact doesn't necessarily go up, because now you're exchanging removal for mitigation. And so you're in a situation where you still haven't actually addressed your low ability to pay kinds of emissions. So these agricultural things, basically, if the question is, would you have otherwise mitigated that emission instead of removed, like you haven't actually done anything at the end if you dedicate that removal resource. So that gets kind of complicated. There's some places where that probably is right, and some places where that probably is the case that you can't actually mitigate otherwise. But particularly for organizations that have high capacity to pay, arguably they're also able to spend that money on mitigation, but that might be a little bit harder than a super commodified CDR market or something along those lines. But I think the other thing that gets why I actually think about this as a limited resource that's not just limited by money is basically for all of the kinds of things that we see as intentional interventions above and beyond what would have happened otherwise, you're either extraordinarily land limited, or you're really energy limited. And when you look at projections for what kinds of energy intensities we might see in net zero scenarios for the United States, for example, we're talking about potentially having to move the electricity system to 5 to 8 times its current size by mid-century. Adding on a bunch of additional energy stock to that in order to support CDR, I think is where the limiting factor starts to come in. Like, you just cannot deploy clean energy that fast. And you start to run into resource constraints on those places too, whether that be land or solar panel manufacturing or some of the inputs or something like that. So because it's time bounded, you end up in an actually pretty rapid resource constraint, mostly based on energy deployability is kind of my view on that.
Right. I mean, and the argument is sound in the sense of like, just stop polluting. I mean, it's a high cost in the environment where, okay, how do you account for people wanting to pollute? Because, you know, we get good stuff from pollution. Because ultimately that's the tension between people wanting stuff, wanting less pollution, and not being able to make a trade-off, right? Yep. So what's the right way of thinking about that?
Yeah, I mean, and that's, I think, beyond like a life cycle assessment question. I mean, it's something we could use LCA for, certainly, but like, this is why I tend to think that we're not going to make much progress on climate without regulation, actually. Like, voluntary action probably doesn't get you there, would be my view. But also being able to account for that in a lot of scenario design of like, what does voluntary action actually encourage in terms of market segmentation versus something where there's a hard requirement is also a place that you can play a little bit and try to show that, like, even in a case where you have a ton of voluntary action, exactly like you're saying, the people that don't care are likely to respond in other ways, and you end up with very interesting patterns of like fossil fuel pricing and things like that when you lose a bunch of demand. And so, yeah, the situation where you have some people constrained by choice and some people that are totally unconstrained doesn't necessarily get you to a particularly good place on the climate front.
That makes a lot of sense. So then, I guess one question, maybe moving a little bit away, is LCA, but in the global sense. So normally you would have, like, I'm thinking financial flows, VAT taxes, say, like you propagate, you know, your, like every time you add value to a given process, you propagate through a product and you can do VAT taxing on it. Same thing, it seems like makes sense for LCA, where you have like e-liability frameworks that count for at least carbon emissions. But it seems like everything applies this way, that you can layer your impacts to understand everybody's entire value chains. Is that doable?
Yeah, we actually, unfortunately, the one model that people were using in the US is no longer being maintained, which is a shame. But we do have something called environmental input-output LCA, which basically is IO tables, but tries to assign the various kinds of pollution trackers that we care about to every unit of money that goes through a particular country's GDP. And you could do this for the whole world too. It's really data intensive, and there's not a lot of incentives to do this kind of thing. And so nobody's really keeping it up, but hypothetically, you could do that for the whole world. What tends to happen in those situations is that you don't end up with high precision. And so they're not, like, again, this is kind of the standard for some reason. They're not really legally defensible because you might indeed have a production plant that's quite different from the average, or maybe even is quite different from other ones within your same company. And so if I'm making a claim about your liability, I actually need incredibly specific information about your processes. But from a just tracking everything perspective, input-output LCA is actually pretty good at giving you kind of a first cut based on a static understanding of an economy if you've got those numbers right. So you can at least get completeness that way, even if you don't have high precision and high resolution.
Got it. And then one relative of this analysis would be like substitutability. So you have, I'm thinking a carbon project leakage concept, that if I were not going to do this, I would have done that. If I would have not bought this product, this is the alternative. And that's more like an international trade flow analysis. I guess how does that fit in into this?
Yeah, and that's, I think, where, so the unit of analysis in LCA is called the functional unit, which is kind of confusing until you think about it really hard. Basically, LCA is organized around trying to evaluate the impacts of providing a particular function. And so to do like a pure good LCA in that situation, what you would need to be doing is essentially making sure that you're accounting for every function that somebody is actually pursuing. Otherwise, you get leakage from your analytical boundary. But basically, if you are redevoting, I don't know, a forest or something to a carbon resource, but you still need to be producing pulp and paper, then you actually have to add on the impacts from that alternative method of providing the pulp and paper if you want a complete analysis here. So this is the system boundary thing, but that function of like, it's not just the function function of removal. It's also the function of removal plus pulp and paper from the forest or something like that is basically how LCA tries to do it. We're not that good at it, frankly, but at least from a methodological orientation, that would be how you would do it.
Okay, so in terms of the units, one other unit is a corporate unit. So oftentimes when you have corporate emissions or impact study, you can just say, I bought this activity and that activity, and in the end, I'm not too bad, right? And in some ways, that's right. I mean, it's corporate, right? Like that level is right. But on the other hand, you haven't actually done anything. So I guess what's your thinking about how to account for these large conglomerates of activities?
Yeah. This is something that a lot of social life cycle assessment people have spent a long time thinking about, mostly because a lot of the kinds of social impacts that we anticipate, which includes economic impacts, are more at the corporate level than they are at the product level. And I probably should have said this, one of the actual weaknesses of life cycle assessment, if this is not the kind of thing that you're looking at, is that it does assume linear impact per unit. And so it was designed basically to say per bottle or per chair or per unit of hydrogen or something like that. If you don't have linearity there, and if you don't have marginal impact with growth, then the method does suffer quite a bit.
Okay, but then for these corporate boundaries, so what's a reasonable way of doing these kinds of things where you could do it per plant, but also you have the entire value chain up and down it, but you also have horizontal things where, oh, here's a nasty one. My farm does this many emissions, so I make sure a nearby farm in the area has lower emissions, or another farm in the area that I own has lower emissions. Is that a defensible, plausible thing, or is it just creates cheating?
Yeah, probably creates cheating. It's a little hard to tell without knowing what the other backstops might be, though.
That's fair. All right, cool. No, but this is fantastic, and we're at time, so I don't want to use up more of your time. But yeah, thank you very much.
Thank you.